Ever wondered how the stock market works? Well, imagine a bustling marketplace, only instead of buying and selling goods, you're dealing with shares of publicly traded companies. These shares, or stocks, represent pieces of ownership in a company. When you buy a stock, you're essentially buying a small fraction of that company, becoming a part owner. This marketplace, known as the stock market, is where buyers and sellers come together to negotiate prices and make trades. It's a hub of activity where millions of shares are exchanged daily, each transaction influencing the price of stocks. The stock market operates through exchanges like the New York Stock Exchange or the NASDAQ, allowing companies to raise capital and investors to make potentially profitable investments. So, in essence, the stock market is a place where you can buy a piece of a company. Now, why would you want to invest in stocks? Well, imagine a garden. You plant seeds, nurture them, and over time, you watch as they grow into a lush, fruitful oasis. Investing in stocks is similar. The main goal is to plant your monetary seeds and let them grow, building your wealth over time. Historically, the stock market has been the fertile soil that offers a higher average return compared to other forms of investments, such as savings accounts or bonds. While these other forms may be safer, they often don't provide the same level of growth. Consider this: if you tuck away your money in a savings account, it may remain safe, but it won't grow much. On the other hand, investing in stocks, while it comes with its share of risks, offers the potential for your money to flourish and multiply. So investing in stocks can be a powerful tool to build wealth over the long term. Before getting started, there are a few key terms you need to know. Let's kick things off with share. No, we're not talking about sharing your lunch. In the world of stocks, a share represents a piece of ownership in a company. When you buy a share, you essentially become a part owner of that company. Fascinating, isn't it? Next up, we have dividend. This is a portion of a company's earnings that is paid out to shareholders. Think of it as your reward for investing in the company. However, not all companies pay dividends. Some prefer to reinvest their earnings to fuel further growth. Now let's talk about the index. This term might sound complex, but it's actually pretty straightforward. An index is a collection of stocks that represent a segment of the market. For example, the S&P 500 is a famous index that includes 500 of the largest companies in the United States. It's like a snapshot of the market, giving you an idea of its overall performance. There are many more terms in the stock market vocabulary, but understanding these three is a good place to start. With share, you're getting a piece of the company. With dividend, you're receiving a portion of the company's earnings. And with index, you're looking at a collection of stocks that represent a segment of the market. It's like learning a new language, isn't it? But instead of ordering a coffee or asking for directions, you're navigating the exciting world of the stock market. Just remember, the more you understand, the more confident and informed your investment decisions will be. With these key terms, you're well on your way to understanding the basics of the stock market. Remember, knowledge is power, especially when it comes to investing. So keep learning, keep growing, and let's turn that financial confusion into clarity together. So, how do you start investing in stocks? The process might seem complex, but don't worry, we're here to simplify it. First things first, you'll need to open a brokerage account. This is an account that allows you to buy and sell stocks. There are many brokerages out there, some with physical branches and others operating solely online. When choosing one, consider factors like fees, customer service, and the tools and resources they offer. Once your account is set up, it's time to pick your stocks. Now, this step is crucial. Always remember, you're not just buying a stock, you're buying a piece of a company. So, invest in businesses you believe in and understand. Take the time to research the company, its financial health, its competitive position, and its future prospects. A great tip here is to think about companies whose products or services you personally use and love. Are you a fan of a particular tech gadget, or do you swear by a certain coffee brand? These might be good places to start your research. Now, you've probably heard the phrase, "Don't put all your eggs in one basket." The same principle applies to investing. This is called diversification. It means spreading your investments across a variety of stocks in different sectors and industries. Diversification can help reduce risk. If one stock or sector doesn't perform well, you have others that might be doing better. And finally, remember that investing isn't a get-rich-quick scheme. It's about growing your wealth over time. So be patient, stay committed, and avoid the temptation to buy and sell stocks based on short-term market fluctuations. With these steps, you're ready to start your investing journey. You're moving from being broke to banking, and that's something to be proud of. Remember, every great investor started somewhere, and today, you've taken your first step. Welcome to the world of investing. Like any investment, stocks come with both risks and rewards. Navigating the stock market is much like sailing on the open seas. There can be calm, sunny days, but also unexpected storms. This is what we call market volatility. It's the rapid and significant price swings that can lead to potential losses or gains. It's also important to remember that not all ships are destined to reach the shore. In other words, there's no guarantee that every investment will yield profits. But why do people still sail, you may ask? Well, the answer lies in the potential rewards. Despite the risks, stocks have historically proven to be one of the most effective ways to grow wealth over time. This doesn't mean overnight riches, but rather steady growth if you stay invested for that long haul. So remember, with risk comes potential reward, especially for long-term investors. Before we wrap up, here are some practical tips for beginners. First and foremost, do your research. It's essential to understand the company you're investing in, its business model, and the industry it operates in. Next, think long-term. Investing is not about making a quick buck, but about growing your wealth over time. Don't be swayed by short-term market fluctuations. Remember, it's not about timing the market, but time in the market that counts. Be aware of common pitfalls. One such pitfall is panic selling during market dips. Remember, market dips are often great opportunities to buy more of your favorite stocks at a discount. Another pitfall is chasing hot stocks without proper analysis. It's easy to get caught up in the hype, but always do your due diligence. With these practical tips, you're ready to venture into the world of stock investing.